the proposed end of cheap money has brought a nasty reality check to many global financial markets. Before the Fed's decision to perhaps reduce its global bond buying program last week, many stock markets were hitting record highs. Simon, it's a completely different story now. What exactly has changed?
Well, as you say, the Fed's decision to consider reducing its bond buying has forced investors to just change the whole sort of risk profile for investors. So whereas they were buying emerging markets for their higher yield, now they're looking at emerging markets and thinking, well, we might get a better yield in the US, or so that's the first thing. But that's only one. I think that's only one part of the story. There's also been other things going on. There's been protests in Turkey and Brazil, which have obviously sort of spooked people a bit. But also there's been for several months now, there's been growing concern about the growth rates in some emerging market countries, and so that's sort of playing into it too.
I mean, a lot of this, while money was cheap, a lot of these countries were borrowing it quite rapidly. So now all of a sudden they have large debts, or some of them have large debts, and now borrowing costs that are going to actually start going up. Is that really the crux of it here?
Well, that also, as that plays into these to this concern about economic growth in some of these countries, because as you say, if they're reliant on, if they've got big current account deficits, so they're reliant on foreign money, hot money that is going to cost them, all that's going to pay into the economy. But it's not. That's only. But that's, as I say, there's also the issue around. There's also concerns about the eurozone economy very sluggish, and that has an impact on exports. So that's another aspect to it. But I think there's a wider context of this, as I say, is that a lot of these countries, they grew very rapidly for 25 years as they entered the global economy and became took advantage of Western outsourcing, and that sort of trend. There's a concern that trend may have now reached its limit.
So in more ways than one, a lot of these markets, a lot of these countries are really going to actually get hurt. But what is the are there any winners of this? Obviously, as you're suggesting, higher borrowing costs are a problem for everybody, and everybody's become so accustomed to cheap money that it's going to be very difficult going forward.
Yes. Well, the countries that will be least affected will be the ones that have the lowest current account deficits, that are least reliant on foreign money. So that would be places like the resource sort of type economies like Russia, for example. But economies with very high reliance on foreign money, countries like Turkey, that could clearly be more of an issue.
But at the moment, people seem to be rushing very much back into sort of the safe havens as well. So it's essentially, at the moment, it's the US that's really benefiting the most, or certainly the dollar and those markets.
Yes, well, clearly what's prompted this is a belief that the US economy is starting to recover, and so therefore can cope with slightly higher interest rates. But of course, but this is sort of quite dynamic, because of course the US is in turn reliant on what's going on in the rest of the world.
Is there any chance here that the Fed, they proposed this reduction in global liquidity, or certainly its own liquidity, is there any chance here that because of the volatility that we've been seeing in a lot of these markets, that perhaps the Fed might step back at all?
Well, the Fed hasn't actually said it's going to do anything yet. All it said is that
it's laid out its sort of
all it said is
proposals.
that if the economy continues to recover, it might do. I'm not sure that it can put the genie back in the bottle that easily, but at the same time also, you've had this report by the Bank of International Settlements this week, which is the sort of central bank as it's known, saying that actually the sort of very loose monetary policy of the last few years is actually starting to do more harm than good, and that actually this kind of volatility is inevitable as we move from one regime to another, and I'm not sure that it's going to serve any purpose to try and to sort of stop it if the economies are recovering.
Simon, thank you very much indeed.